All right, welcome to today's talk. We're talking about money and what you need to know to have more of it. Keep it that simple, that's what people want. And one of the areas you're gonna have to understand, although I will tell you, it's somewhat, I'm gonna say this is an overrated area, and for some people it's underrated, but you still need to know it. We're talking about the stock market. So why do I say it's overrated and underrated? Okay. Let me do both. So when we talk about the stock market, you know, that's kind of one of those things that people traditionally associate with making money. So let's talk about kind of like the old pros and cons list. When it comes to this, it's overrated and underrated, and here's why I mean that. Okay, it's overrated because you're not going to make as much money as you think. At least most people won't make as much money as they think through the stock market, okay? It's underrated because you still want to know about it, because the principles that you learn in the stock market are relevant to all areas of making money. Because after all, what is a stock market? It's an exchange, okay? It's an exchange where businesses basically get investors. So if you're writing that down, write anything down, which you should be, write that down. All the stock markets, and there's various stock markets in New York, in Chicago, in the UK, in Asia. There's all a variety. In fact, I'm not sure the exact number of total stock markets. You mostly hear about the New York Stock Exchange, NASDAQ, and so on, but those are just a few exchanges. So the first thing you have to do with the stock market is you have to understand it's just an exchange where people are trading stuff. So I own a company, let's say I owned McDonald's and I want more money in my business. So I go, I'll give you one share, okay, of my business. I'll give you some ownership of my McDonald's company. And so I go out and let's say I issue 1 million shares at $100 a piece. That's $100 million I want to receive into my business so I can grow my McDonald's restaurant franchise. So it's an exchange where you as a buyer can meet me as a business owner. There's a few little variations, but for the most part, what I just said is the basic fundamental rule that you need to understand about the stock market. Now, the other thing is, the stock market does is if you've bought shares directly from me, okay, that's called like an IPO, or there's different offerings, but let's call it an IPO, an initial public offering. I'm launching my restaurant business. I issue 1 million shares. You can buy one of them or you could buy all 1 million, and you give me money for every piece of the business that I give you. The stock exchange also allow you to sell your shares to other people and trade, okay? That's like a secondary market. So anyway, that's not the main thing I want to talk about today, but that's the fundamentals. Some of you already know that, but it's very important. And by the way, if throughout this whole program, if you know these things, because a lot of people tell me all the time, Ty, I already know that. And I'm like, but could you teach it? It's a great test. Try it sometimes. If you have kids, brothers, sisters, friends, try to give a little talk on the stock market. Try to give a little talk on a book you've read. Try to give a little talk on investing in gold. Try to give a little talk on budgeting. Try to give a little talk on entrepreneurship. This will put your knowledge to the test. And most people don't realize how much head knowledge they have, but they don't actually know the fundamentals well enough to be able to teach it fluidly. So, and simply. The mark of a good teacher is they can say something complicated very simply. So again, I want you to be able to have the simple parameter in your head of what a stock market is. Now, it's overrated because the odds are most people who invest in the stock market, they make about, at best, okay, year in, year out, let's just say 7%. The statistics actually show the average person who puts money in the stock market makes less than this. And of course, there's people who make much more. But remember, it's kind of like the lottery. If I tell you, well, most people, the average person loses money on the lottery, you can't come to me and say, well, I saw someone on TV who won $100 million. Well, of course, but that's the exception to the rule. You want to know the rule, okay? Now, there are ways to be more exceptional, but I'm telling you, and I can tell you this, not just me, but I can tell you this from the highest level, whether it be Warren Buffett or these people that are the kings of the stock market, George Soros, you know, there's hedge fund managers. For the most part, unless the stock market is something you really spend a lot of attention and focus on, it's not going to be the main source of wealth that you create for yourself. It will not be. Now, there's a few people that become day traders. Most day traders, over time, it's like playing a Las Vegas slot machines. They lose over time. There's very few, even the greatest hedge fund managers. I read something, and a hedge fund, by the way, is a very sophisticated investment strategy company, I should say, that employs specific strategies that are outside the realm of what we would talk about in a basic money program. They do high frequency trading, short-term trading. They hedge their bets and they it's complicated. We don't need to know that at all. But even the top hedge fund managers, I think there's never been a hedge fund manager on top of the ratings more than 1 year in a row. That means there's a good bit of luck on it. And there's a lot of, it's controversial, but there's a lot of researchers that say a lot of what you see in terms of people getting big returns is luck. Okay, so again, just like the lottery, somebody always wins the lottery, but it's not applicable to your life because what lesson can you get from the lottery except that it's luck? You don't want luck. So when you look at the statistics, the average person makes about 7% on their investments in the stock market, and after you subtract fees and costs, let's be conservative, that's 2%. After you subtract taxes, depending on if it's a retirement account or a taxable account, and whether it has dividends, let's say you use another 2%, okay? That's what? 3% left. And when you take inflation is basically the government's continually printing more money, and it makes your money worth less. That's why, like my grandpa Charles, when he was a little boy in the 20s, he said I could buy a meal, a loaf of bread, for 5 cents. You could buy a whole everything. And now, what can you buy for 5 cents? Nothing. It's like almost a waste of money. So, I mean, a waste of time to think about things, even nickels. I know some people that don't even carry change. Even me, I don't carry change anymore. It's like, it's been devalued by inflation, and it will continue. So if you have here, let's say a 3% return, inflation's been 2 or 3%. So the average person in the stock market, they call this your real return, okay? Real return is after taxes, after fees, after inflation. Your growth of wealth for most people is close to 0 to 1%. Even somebody who earns 10% on their money. Now, so that's why I say the stock market's a little overrated. But why do I say it's underrated? Well, it's a great source in most countries and most states, you get some tax advantages of investing in the stock market through a retirement plan like a 401k or an IRA, or if you're outside the US, you have some different names for them. So they're useful because you might work at a company or might have a stock option plan, a 401k matching plan, where the money you put into the stock market in your retirement plan, the company gives you free money and matches. So you want to take advantage of that. So the reason it's underrated is a lot of people don't understand how you can use the stock market as a tax, to your benefit tax-wise. The other thing, the reason is it's a good source of passive growth of money. But let me go back to this side. Let's just pretend that there was no fees, there was no taxes, there was no inflation, and you actually could grow your money at 7%. There's something called the rule of 72, which tells you how long it takes to double your money. So let's say you have $1,000 today, okay, to invest in the stock market. At 7%, that means in 10 years, you'd have $2,000. So let's say you're watching this, you're 30 years old, what is hypothetical. When you're 30, you invest $1,000, stock market, you get 7% return. 10 years later, when you're 40, you have $2,000. When you're 50, you have $4,000. When you're 60, you have $8,000, $16,000, 32. So, unless you start with a decent size capital investment, if you start with $1 million, that's great. You start with $1 million and you get up to $32 million by the time you are dead, basically 80 or 90 years old. That's great, but most people, their initial investment in the stock market is not $1 million, and also that's not counting fees, inflation, and taxes. So even in a best case scenario, if you're not starting out with a lot of money, the stock market is not the way that people bootstrap themselves from zero to a lot. There's a few stories of some day traders and stuff like that. There's some systems out there where you can make some money, but there's nothing consistently working. So that's why, again, I'm not trying to discourage you. I'm just saying, I'm just laying out the facts. If you have a large amount of money, or somewhat larger, it's a great way to passively grow your money, because when you invest in businesses through a stock exchange, through your retirement plan, you're getting little bits of those businesses, and while you're sleeping, they grow. So it's somewhat passive automation of money. But again, if you only start out with $1,000, you're gonna have, before subtracting taxes, inflation, and fees, you're gonna have $30,000 from that at the end of your life, right? And the odds are you're gonna need some of that money before the law of exponential growth can really kick in. So it's great if you have a little larger chunk of money for passive investment. It's also great for those of you, as you start to make money, as a source of diversification, okay? Just remember though about diversification. Diversification is to lower your risk. It's not to create wealth. Wealth is created by focus. So you do the opposite. So diversifying let's say you own a business that's making you money. You are at a crossroads, and you can only pick one path or the other. If you choose to focus and reinvest all the money from your business back into the business, that's what we call, single stock risk, where you're focusing everything on the stock in your business. Well, guess what? There is a huge risk that business fails and you put all your eggs in one basket. But the flip side is also true. If the business hits big, you've built it, just what Bill Gates did, just focused on Microsoft, and it made him the richest man in the world 16 times in a row. So there comes a time though where you've made enough money and you want to diversify, and that's where and you want to avoid risk. And that's where diversification through the stock market makes the most sense to me. But it's not a wealth creator, and this is the myth. It's not a wealth creator for 99.99. If you're watching this and you really want to learn how to day trade, and do options, and all of these things that are much more advanced, I'm actually going to roll out, I think soon, a specific course with a couple people that I know are really good at that. But I want to warn you, look, if you go around planet Earth right now and find people who started with $1,000 and became wealthy just from the stock market, you're going to hardly find anybody. I'll tell you where you'll find the most people is if you go and say, who started with $1,000 and built a business that made them $100 million. You'll find thousands of those. 10 million or more, let's say. You'll find tens of thousands of those. In fact, in the United States, there's millions of millionaires. I can't remember what the number is. It's between 1 and 4 million millionaires. And the amount of millionaires through the stock market that are relatively young, under 70 or under 60 years old, are infinitesimally small. So again, that's why I say it's overrated. But there are some of you, and that's a separate whole program we're going to roll out, is like day trading. And the reason I say separate, it's so specific that I wouldn't put it in this program, because it's not like me. The stock market has been an insignificant part of the money that I've made. I made a decision a long time ago. Remember, I come from a background when I worked at GE, I had my licenses, stock. We were managing people's money, one of the first business. So I know what I'm talking about. And I knew all about it, and I was like, nah, that's not the path I'm gonna choose. The tried and true path for wealth creation has been entrepreneurial ventures. Always. Boom, boom. You just go through the richest people in the world. It's either being born rich or entrepreneurialism. That's it. There's nobody on the Forbes list. Nobody who built it through the stock market. Nobody high up in the stock. There are some people. Real estate does better than just pure trading. Now, with one exception, if you want to start your own investment fund, like you want to be like John Bogle, who started Vanguard mutual fund family. If you want to be these big traders, if you want to be a private equity manager like, you know, Stephen, what's his name, that started Blackstone. Sorry, my mind. Schwartzman, thank you. Stephen Schwartzman. If you want to be him, certainly then it's a whole different, but that's a career choice. What I'm talking to you about is what you can do in your part-time. The best thing you can do at a part-time, no matter what anybody tells you, is use the tax code where you live to max out your retirement benefits and invest in the stock market through your retirement benefits. Although I will tell you, the law's changed a lot in various places where you can even invest like in real estate through your retirement accounts. You don't have to invest in the stock market. You used to pretty much have to invest in the stock market to do a retirement plan, tax advantage retirement plan. So yeah, this is kind of my talk. For some people watching this is like deflates them, but I'm still going to tell you what I follow for my own life. That's why you're in this program. I'm not going to lie to you. So again, some people watch this talk and they're like, Ty's going to teach me how to make millions in the stock market. I'm not. I didn't do it, and I know of very few people that ever did it. And when I started a wealth management company, and I've seen how thousands of people firsthand how they created their wealth. I've read books. I've looked at the statistics. Now I have my hand in many things as an investor. It doesn't work like people generally think. I know the people that they're exception to the rules, but I don't think it's applicable to most people. But I will tell you what I do believe in is investing. But there's multiple places to invest in, not always the stock market. Now, for those of you who still want to know about the stock market, which I believe you should still know, let me give you a few things to understand that I think are important. One of them is this principle that I said. Write this down. You diversify in the stock market not to create wealth, but to preserve and protect wealth. Okay? You get rich through focus on one or two things. So you're always going to have to make that decision. The money you invest in the stock market, the more you diversify it in general, if you do it right, and a lot of it's automated now with algorithms and computer programs to help you diversify. Just remember, it's going to protect your money much more than if you focus on one thing, one stock, but your chances of making a lot of money, a high return, are much lower. If you're one of those people that says, I don't care if I lose all my money, then you can invest much more focused. Like some people you'll meet, they're going to be like, ooh, I'm investing in Apple stock, or ooh, I'm investing in, the next Google. And they go, I want to get in when it was 100 and now it's, 300 or 400. Well, that's great. Hindsight is 20/20, but there's always stories like that. There's buildings you could have invested in LA for 10 grand in the 60s. And that's what Dr. Jerry Buss, who owned the Los Angeles Lakers, he died recently. He took a $14,000 investment. He didn't have $14,000. It was him and I think two other people. And they bought a duplex piece of real estate here. And he, ended up buying the Lakers for $70 or $80 million and dying one of the richest people in California. He didn't do it to the stock market, and it was risky. So leveraging, so diversification, just keep that in mind. Very important. If you get that one fundamental thing, you'll be miles ahead of the average person. Because most people go, oh, it's safe to just invest all my money in Apple stock. Well, it's not safe to just invest all your money in Apple stock, but it does give you the potential for more return if it does well. But you got to be able to you have to be willing to know if you lose your money. Don't be crying about it. It's, don't cry about it. You could say, I watched this video and this Ty said, diversification, when done correctly, lowers risk, but focus, they call that concentration on one stock, gives you potential for more return. So you have to decide, and they call that the risk return spectrum or the risk return pyramid, and you have to decide how much risk you want. Nobody can tell you that in a video. Nobody can tell you in a book. And the best way to know yourself. When you've lent somebody $100 and they didn't pay you back, did it freak you out? If the answer is yes, then you have a low risk tolerance. I mean, that's something that people forget. So the other thing I want that you need to know before you invest in the stock market is a non-delusional risk tolerance. And this is a word that's kind of thrown about formally, risk tolerance, but I'm just saying, I just gave you the keys to the kingdom and understand risk tolerance. You give somebody $100, they never pay you back. Are you still thinking about it 1 or 2 years later? If the answer is yes, then you probably have a low risk tolerance, and you better be careful in the stock market, because the stock market giveth, but the stock market takes away. I've seen people lose $1 million overnight, and you have no control for the most part. If you start selling, sometimes that's even worse, because then you sell when the stock price is low. So if you're okay, if you have $1 million and you're okay with theoretically waking up with zero, okay? Especially if you invest $1 million in one stock. Now, if you invest $1 million in Apple, are the odds that you're gonna wake up and have zero? No, but it's happened before, that big companies have fallen. J.C. Penney's, Yahoo. I'll tell you a story about the stock market. Mark Cuban, who the billionaire you probably have heard of, he's on the hit show Shark Tank. Mark Cuban was paid, he sold his company to Yahoo, and Yahoo paid him in stock. So they gave him shares in Yahoo. And he had one smart investment advisor who said, you should buy options to protect. And options are basically kind of like insurance. Not exactly, I'm oversimplifying, but it basically means if the value of your stocks go down, there'll be money to offset the loss. So thank God he listened to that investor, because I think at one point Yahoo stock was worth $100 or $200 per share, and it dropped to like $7. He would have literally, you would never have heard Mark Cuban's name. So his investment advisor told him to diversify. That's this dangerous thing about having all your eggs in one basket. Mark Cuban could have gone to from being worth $200 million to being worth $7 million, and that was in a big company, Yahoo. So never think that you're 100% covered just because Google's big. Google has a huge antitrust lawsuit against it in Europe. So even the most sure bet in the stock market is not always a sure bet. It's not. And there's countless stories. It's kind of like the Titanic or the Lufthansa. People go, this ship is too big to sink. No. That's famous last words. And then the next thing you know, Leonardo DiCaprio is making a movie about your money sinking to the bottom of the ocean. Now, with that, I don't want to scare you and think that you should never invest in the stock market. So what's some practical things you can do? Well, I like what Warren Buffett says. For most people, best thing you can do is invest in index funds. What are some good index funds? The big ones, Vanguard is one. You got American funds. Those you have to do through if you have an investment advisor. There's literally about 10 decent funds. And you can look at ones, Tony Robbins just wrote a book. I forget what it's called, The Rules of Money or something, where he does all these specific interviews. This program that you're in, it's more about what I would do if I was 18, what I wish I knew. So what I basically wish I'd known about the stock market is, it's a great diversification tool. It gives you some passive income, but it's not my focus. And for most people, unless you're addicted to numbers and trading and sitting in front of a screen, it's not the main, you're not gonna look back in your life and go, whew, thank God that stock market was there. Now, if you invest well, and you're in a company that has a 401k, or you're a business owner and you set up an IRA, and you get some tax advantage growth on that money, you might look back 30 years from now and have a lot of your nest egg tied up in those retirement plans. That's why I said, don't underrate the stock market and don't overrate it. You got to see it clearly. It's a tool. It's one tool. It's a misunderstood tool. It's a hyped tool for many people. And the real thing is focus on the other parts of this program. If you're only in the money program, make sure you focus on the entrepreneur program. If you can afford it, move up and include the entrepreneur plan. You can click the help link, because that's where you'll make the most money. And if you don't believe me, just go to Forbes.com and put in the list of the people who have made the most money. And you'll see without a doubt how most of them made it was through business. Your own business, or you being a part of a team in a new business. You don't always have to be the entrepreneur. Some of you are, they call that producers versus performers. But being actively involved, that's the thing why I don't put most of my money in the stock market, is I don't like the feeling of losing control. You know, you wake up in the morning and imagine 1929. You know, 1929 stock market crash, or in the 1980s, or there was one in 2000, there was one in the late, whatever, not too long ago, 2008, these market crashes. I don't like that feeling. I like having businesses with predictable income that pay me whether the recession is going up or down. And that's been the plan that I've done. And it's not my plan. It's the one the tried and true that I followed from people much more advanced than me. So we'll continue to talk in this program more on stock. If you came in here and you thought that was going to be the main thing you're going to learn, no, I'm going to teach you things more important, okay? Or you're going to learn, not me just teaching you. We're going to be talking about things that are very important. But little reminder, make sure you come to the twice a month live calls with different teachers, me, and I'm starting to add some other teachers. That's the most important part of this program. These, what you're listening to now, are little kind of tidbits to keep you moving forward. But that twice a month call where you're reading the books along with us, that's where you're going to get the big bang for the buck. And we're going through some books that are much more specific on the stock market. I had to make a choice with this program. Did I really want to get super in depth to the stock market? And I made the choice not to, but we will have a separate course eventually. I haven't launched it yet. That's super nitty gritty, and it'll be taught by some people who do things like day trading, but I'm not as in love with I've seen those programs. It's a good way to make some money and feel like when I was 10, I made 10 or 11, I made money by buying a lottery ticket, and I was like, yes, and I kept betting on the lottery ticket, and guess what happened? I went up this far, and I went right back down and even below. So be very careful with those, okay? So thanks so much, and here's the questions that I have for you. Number one, what are you doing? And this is the most important one. How are you using tax advantage retirement plans where your money is invested in the stock market through either your company, or if you're self-employed through a company, or however we have quite a few different countries here, so this is applicable to about 90% of them. But how are you investing in the stock market through tax advantage plans? And if you go, Ty, I have no idea, here's my advice for you. You must go to a local accountant and get them to help you. It's too specific of advice that there's no way I could give it to you on camera, because there's literally in the United States, there's 10 or 20 different ones and it depends on where you are. It even depends on how old you are, which one's better, how much income you make. There's some limitations on them. So you got to get specific advice. That's the first question though. How are you using them? If you're not using them all, that's a problem. You need to use them. Almost everybody should use them. Number two, risk tolerance. Are you super risk tolerant or not? If you lost $100, has it haunted you? Okay, that's question number two. And question number three, are you more interested in safety through diversification or wealth creation through concentration, even though it's a lot riskier and you might lose it all? Which of those is more your style? So answer those three questions, and I will see you on the next talk.